Today I'd like to introduce a special guest. We've had Matt Wacher from Morningstar Investments. Matt is actually the Chief Investment Officer for Morningstar Asia Pacific, and now we're post-COVID. These guys are actually out visiting with us, which is fantastic. So I thought I'd take the time to actually do a short interview with Matt to talk about Morningstar, more specifically where they've come from recently. We've had a period of high volatility and effectively where we're going. So Matt, yeah, you guys have come off, obviously it's been difficult times with rising inflation, but how do you feel about things going forward?
So it's been it has, as you say, Murray, been a very difficult period for most investors out there. We've been lucky in that our portfolios have held up quite well over the last year, in spite of some of the hostile markets that we've faced. We went into 2022 without many bonds in our portfolios that did very poorly last year, and we tried to focus on valuation in terms of our approach to asset allocation and the assets we owned. And so we were lucky in that we avoided some of the heavier losses. Our portfolios were still down slightly, but what last year did was enable us to actually start to really reposition our portfolios, start to build more resilience in them. So we've been able to add from our cash holdings into the bond market. As yields have risen, it's provided us the opportunity to do that and get much better reward for the risk that we're taking there. And similarly, in some of the other the equity markets that have been sold off, we've been able to get much more diversification into our portfolios over the last year.
And you've seen opportunities in the tech space in the Americas, haven't you?
Yeah, we have it. Starting, some really high quality businesses have been sold off quite significantly. So, while we're not going all into tech, we've certainly got higher allocations than we've ever had. We like companies like Meta, Facebook, and Alphabet, or Google as it's called now, and other areas in communication services like not so much Netflix. It's an okay opportunity, but things like Disney that are into streaming and those sorts of things, and their broader businesses is looking quite attractive. That whole sector now.
You've had a good bit of a look at China too, I understand.
We have. I can't comment on any geopolitical issues. I have no idea what's going to go on there, but that's I guess the risk there. But in terms of China, they've got some very high quality businesses as well, like so Alibaba and Tencent. All of these businesses that I've spoken about, we didn't own a year ago. Because they were too expensive, they're all very high quality businesses, and with the sell-off in markets, we've had the opportunity to take a foothold investment in them. So that's good, and that means that we think we can generate long-term returns for your investors.
And 12 months ago, you were very bullish on energy stocks, Woodside, and those types of things. Yeah. You've taken a few profits there, I understand.
Yeah, we had a fairly large allocation to energy stocks, mainly oil and gas type stocks, but we've taken that down significantly. We have a very small allocation to energy. Really now it's a matter of you're trying to focus on having a diversifier in the portfolio in case inflation does rear its head again. It seems to be tapering off a little bit in the US, but it could come back quickly, and so we want to have something in the portfolio that can help there, but much lower allocation than we had 12 months ago. We took a lot of profits there, which was good.
Which is good, yeah. And I think you've also mentioned that Europe's actually not turning out to be the basket case we thought it all was going to be. Things are looking a bit better there.
Yeah, which is interesting to say about Europe. Not many people give Europe much credit, but with lower valuations and actually things, as you say, not being a huge basket case, they had some luck there with the weather. The weather wasn't as bad as everyone hoped or was thinking it would be, and so that's meant that natural gas prices have fallen. Inflation has been able to moderate a little bit quicker than probably what they felt. There's still some risk there, but we think it's quite attractively priced relative to other markets. So we've got an allocation to Europe as well.
And lastly, Matt, the dominant narrative right now is we might have a soft, third and fourth quarter, and maybe the first and second quarter of next financial year might be a bit stronger. I'm not asking a forecast because that's folly. We all know that. But How do you guys feel about things?
Look, we you know, at the risk of having a foot in each camp, we think that at this point in time, you can build a pretty nice portfolio that's going to generate long-term wealth. There may be some bumps along the way, and what I would say is don't be scared of those bumps. They're there the times that you can actually take advantage of the markets and add to your growth assets and generate really good long-term returns after a period that's been tough for investors. I think we're more in the hope camp than the negative camp at this point in time.
Excellent. Well, Matt, listen, thanks for taking the time to meet with us today. Much appreciated.
Not a problem. Thanks, Murray.